Hey, good morning, everyone. Marty Missouri here, your pre-market update, September 5th, 2019. We're about 11 minutes before the open. Finally, folks, we are breaking out of this long, kind of nauseating, if you will, for lack of a better term, range that we've been in through the entire month of August. Originally, I was really painting a picture that said, odds favored this, a breakout below through the 200-day moving average, lower lows, that sort of thing. Then we stayed in here. Then I said, the longer we stay in here and the more we bounce up against this resistance level, the more it looks like we are weakening it. Last week we had a good string of rallies in here. We thought that maybe the U.S. would delay the tariffs over the weekend. We didn't get that. We got the good Hong Kong news. And remember in here yesterday, I said, it could be that we get news that trade talks are scheduled for September to push us through here. And I think that would do it. And if it does, there is a raft of shorts right in here. Make no mistake. And these are the folks who have been winning this battle over and over again in here. And then there's just generally a real awareness of deteriorating fundamentals and the feeling that under the surface, the industrial sector is breaking down. We got an Institute for Supply Management manufacturing survey that basically said the manufacturing sector is in recession already. So we've got a lot of under the surface deterioration that we've been talking about for weeks. So definitely, I think have been some players in here expecting, this to fail up in here and to break down below these levels. Well, the news again late last night, and we saw it in the futures market. I posted on it immediately when I saw it. Was that early October, the U.S. and China is going to get together. Now, my view is that it's not September because in early October is the People's Congress in China. And that is a huge meeting, and China is, as I said in the blog, notorious for keeping things as calm as they possibly can in the financial markets and the economy to the extent that they can manipulate it. So that makes sense. Also, there's speculation that China is going to make the talks tentative, and they're looking for a good faith gesture on the part of the U.S. that would delay tariffs that are set to go in force on October 1st. Frankly, I had forgotten about those. I remember it was September 15th and then December 15th. Well, there's also a tranche that goes into place on October 1st. So China, it looks like, or at least there's some speculation that China's going to be asking for a delay of those tariffs before they actually firm up a date in October. So maybe it's a little bit of both. Their upcoming meeting, I think that's for sure part of it, because right now the sides are miles away in terms of what they're willing to do. Make no mistake. And last night I read a lot right from the Chinese state media. They really don't think there's much hope for a deal anytime soon. China basically is going to demand that all tariffs be eliminated that have been created during this entire process. The U.S. side has no stomach for that whatsoever at this point. The market seems to be willing to rally on just delays of pending tariffs, and that's fine. And I think the market will continue to rally. I think we can even threaten all-time highs up in here. I think that's very much in the cards with this kind of news if it were to continue, but of course you just don't know. But folks understand that the deterioration, the real hard and soft data deterioration is not about pending tariffs. It's about the tariffs that have already been put in force and the supply chain disruptions and the freezing of capital expenditures and the things that go with that. So I have maintained that we can't get bullish. I don't believe the data will allow us to until we get a complete rollback of everything that has happened under this trade war with China in terms of tariffs. Hopefully, we get some of the good things that need to be done on behalf of the U.S. and the rest of the world as it relates to some of the cheating that China has done. Has nothing to do with the trade deficit, by the way, which I've made that point in here. Has everything to do with egregious intellectual property theft, forced technology transfer, stuff that, of course, absolutely has to stop on the world stage. Tariffs, though, are just economically destructive. And that's something that if we can get beyond that as a tool, I can get optimistic again. as long as we haven't already rolled into recession. Now, this morning's jobs number from ADP, the private sector payroll, was amazing. It was 195,000 jobs. They expected 148. Jobless claims were a little higher than last week, but still in a very, very low range. In terms of productivity, that number came out today. Productivity was up a little bit, but labor costs were also up notably. Of course, the one that counts is tomorrow. The jobs number that the Bureau of Labor Statistics, the government jobs number, will be released. So we'll look, the headline number, I think it was 168,000 last time, which is perfectly fine. The labor market is still a plus in our index. We'll be looking for average work week, though. That has been declining, and that usually begins to decline before we get a sustainable decline in the numbers. My view is that when I look at the macro conditions, notwithstanding what we got from ADP today, that as long as the deterioration continues and it hasn't let up really in any measurable way, these jobs numbers will begin to deteriorate, and that will begin to put stress, more stress on the markets and so on. Again, though, I mean, tariffs go away, animal spirits come back, and that could be something that if it happens relatively soon, we could be okay. Last year, when the market was falling apart, when it was down, even 20%, our index was still scoring nicely in the green, and we were very sanguine. We basically said this is either volatility to ignore or volatility to buy. Here we are now, maybe a percent or two from all-time highs, and I am not the least bit comfortable with where we are in terms of the macro, which says that this market is kind of skating around on some thin ice, and if some of that ice breaks, we get a precipitous drop lower. So we have to stay defensive. Clients, we are actively hedging everyone's portfolios, or in the process of doing that. And I think that's key because the risk reward right now does not allow us to just be as exposed as we were even last year when the market was coming down. We recouped from that very nicely. We've had a good year so far. So right now, clients, it's all about preserving as much of those gains as we can and protecting against something bigger happening. And we'll continue to assess that day in and day out and act accordingly within portfolios. But right now, we're going to give up some of the upside to protect from a lot of the downside is the strategy we're using with the current hedge that we have on. But anyway, so in here you've got short covering for sure. Saw it in the futures market. It was huge, that graph that I posted last night. And now we have the cash session starting in about 2 minutes. You're going to hear the bell ring here in a second. And we'll see how the market goes beyond that. Here's the hourly chart that we've been looking at here on most days lately. And again, bumping up against this bump range, bumping, breaking through last night. Here's that huge move in futures. It's like the market just jumped up to about 29.70 and then is trying to hang on. You see the weight coming up in here and so forth. So we have clearly broken out of this trading range. It would make sense to come back and test this as support at some point. That could even happen today or in the next week or so. But if we are going to stay up in here, it makes sense we'd come back, test it, bounce off of it, and then establish a new range somewhere up in here. Or, something else happens and we fall right back through here, which is still, there's that bell, which is still ultimately my base case based on everything I see in the data and in the longer term technicals, frankly. And I'm going to close with those here in a second. But right now, if you look at the hourly chart, and again, futures will continue to trade, even though you just heard the bell. At the cash session, we could go to that, but we won't. We'll just stay here. You can see right here, in these technical indicators, again, they work on a short-term as well as a long-term basis. So right in here, you have the makings of a of a negative divergence. You have the market trying like crazy to push up through here. You see hugely overbought conditions there. That was bound to come down. So if a person was waking up this morning in the cash session and wanted to trade this thing, if I were doing that, I would wait for some resolution in some of these technical indicators before I jump onto that bandwagon. Notice how they work. You can see in here, notice the divergence lower, even though the market was going up. Right, and you can see what happened when they resolved higher. Then you could buy in and see lower, boom, big dip, positive divergence, jump on board, that sort of thing. So you'll see this sort of thing over and over and over again. So these are pretty good. These are pretty good, reliable indicators. Now, what's very interesting is the fractal nature of markets. what works very well on a short-term basis also can be very telling on a long-term basis. This is just basically the aggregate opinion of everyone in the market, and it's the aggregate opinion of everyone in the market that ultimately moves the market. So I'll use that as my segue into my close for the morning. And for example, these are those same two indicators, the moving average convergence divergence, or the MACD, and the relative strength index, or the RSI. Here's a weekly chart of the S&P 500. Here we are going into the tech bubble with an upward sloping wedge, which is almost always a bearish pattern. And then we had our negative divergences on the MACD and the RSI, and we had a doozy of a 3-year bear market, although a very thin recession, but a big bear market because of the tech bubble. Here we had an upward sloping wedge. We had huge divergences. We had the worst recession and bear market since the Great Depression. Nearly 20% correction during the European debt crisis in 2011, about a 16% correction here in 2015 and 16, negative divergences. Here we are on the weekly chart, really negative on the RSI, negative with the sell signal on the MACD, and an upward sloping wedge. So reason to be concerned does not mean that this is going to play out this way like these did. Not at all. Could be another correction. Could be nothing. Could be that we move sideways for a while, resolve higher, get the trade war figured out, new highs, let the hedges expire or roll out of them early, and just keep moving forward until we get more signals that the end may be near. But right now, we're getting those signals, so we have to act accordingly. On the monthly chart, where you get less false signals, upward sloping wedge, negative divergences, tech bubble bursting, upward sloping wedge, negative divergences. This is flat while this is going higher. A huge bear market, European debt crisis, correction. Notice a lot less noise. These are more reliable indicators when they show up on a monthly basis. So I do not like what I'm seeing here on the longer term charts, to say the least. And recognizing that, we could go higher into all-time highs. While these divergences persist, as long as the macro also is giving us a warning sign, then we have to remain defensive in portfolios. Back in here, where these divergences existed, we paid attention to these, but we had positive macros. So we really didn't make any aggressive moves within client portfolios. Yes, some sector tweaking to try to mitigate some of the risks that we saw. But for the most part, our data in the aggregate was saying the bull market is still intact. That's just not what it's saying right now. Doesn't mean that it isn't. It's just not what our data and our indicators are telling us. How the S&P is trading relative to small caps and transportation stocks. Warning signs in here that were there during all these major bear markets and corrections. Stocks to bonds. This is stocks underperforming bonds while stock market is actually going higher. You can see this is not a good look. We have this data up just before the last recession. Lower lows, lower highs, big bear market. Here's corrections, and you can see actually at higher lows, which early on were telling us that these are more apt to be corrections as opposed to bear markets. Unfortunately, we don't have that here at this juncture. We have the makings of a lower low, which is another reason to stay cautious as it relates to this particular indicator. And then lastly, 2 weeks ago, we got a -10 on our index, our macro index, which is now 86 different data points that I score every weekend. We were a -10 right before the tech bubble burst, and then we got a big rally, virtually to all-time highs. We were -36 before the real estate bubble burst. Then we got a big rally to all-time highs. Again, negative macro on our assessment, moved to all-time highs. And I was telling clients in review meetings that you may hate us right in here because we're going to be forced to get defensive, which means to some degree or a great degree, we're going to be giving up a lot of gains from this point forward. But our assessment and history and now the technicals tell us that that's really what we have to do, or we're not doing our job. Our job now is to protect against this potential. So again, the fact that we're rallying in here, I know it's on trade news, but just ending of the trade war, delaying tariffs would be good news as well that could push us to all-time highs. The fact that the stock market is moving higher does not make us want to jump on board based on what I'm showing you here and what I'm showing you in the technicals. So stay tuned, folks. As you know, I will be back frequently, both on the written blog and on these video sessions. Today went a little longer than I expected, but I think it's important that we keep you abreast of what we're thinking in the midst of what right now looks like a pretty good, pretty robust breakout from this sideways range we've been in for the last month or so. Thanks as always for watching and listening. Talk to you again very soon. Take care. Bye-bye.